Thank you for taking the time to participate and listen in to our Dividend Assets Capital Private Wealth webinar series. I'm Jim Haley, the CEO of Dividend Assets Capital, and I'm thrilled to be moderating our discussion today with the Policy and Taxation Group. If many of you don't know, Policy and Taxation Group has been around since 1995. They are the voice for successful families and family offices and family business in Washington, D.C. They exclusively focus on critical tax and economic policies that impact those successful families and those family business owners. They have worked successfully over the last 30 years to reduce and eliminate the estate tax, the gift tax, and generation skipping transfer tax, while also blocking increased income taxes, capital gains tax, and the creation of a wealth tax. So our firm is thrilled to be a strategic partner and support the work that's being accomplished by Pat and her group within policy and taxation. It is an honor to have Pat Soldano here today, Russ Sullivan, and John Gugliada joining us. Pat is the president and founder of the Tax Policy and Taxation Group and has been leading this effort and this advocacy work for over 30 years. Russ Sullivan is the chair of the National Tax and Policy Group at the lobbying and law firm of Brownstein. He's a Capitol Hill veteran who spent 14 years with the Senate Finance Committee, including 9 as staff director. And John Gugliada is the director of engagement for the Policy and Taxation Group. He's a seasoned business executive who has worked and partnered with CEOs of both large and small businesses to help grow their top line. I think you're going to find this afternoon's webinar very informative and very educational on the work that Pat and her team are doing. And as a reminder, there will be an opportunity to answer questions from Pat, Russ, and John as we go through this. So without further ado, I turn it over to Pat.
So today what we're going to talk to you about is John's going to go over the annual survey that we do at Family Enterprise USA. We're known for this survey. He's also going to talk about the Congressional Family Business Caucus. I'm going to give you some insights into what our priorities are, and most recently, a family business survey we did with voters using Frank Luntz. And then Russ is going to tell us about the political and legislative landscape, what's happening, what you can expect with what's going on right now in Washington, D.C. around trying to extend TCJA. So with that, I'm going to turn it over to John.
Thanks, Pat. Appreciate it. And thank you, Jim and Dividend Asset Capital. I know Jim takes the level of engagement with us to the nth degree, and we cannot be more happy with the group and his contribution to our organization. So thank you, Jim, and the team at Dividend Asset Capital. I'm going to quickly give you some information on family businesses. This is information that we take with us when we go to Washington, just to give you an idea of the power of the family business in terms of the economy. That's where we found there were over 30 million family businesses in the country. We found that 87% of the businesses in the United States are family-owned entities. They generate over 80 million jobs, and that's 59% of the private sector workforce. It's also 54% of the private sector GDP, and it's almost about $8 trillion. So these are pretty powerful numbers when we have to sit in front of lawmakers. As Pat mentioned, we do an annual survey each year. Each year, these results are communicated to and presented to members of Congress. I'd like to thank EY. They're our Platinum Plus sponsor for the survey for the second year in a row. And then a big shout out to all the family business centers, as Pat mentioned, and the sponsors and the strategic partners that help us distribute the survey. So this year we had 730 respondents, a little less than the year before, but we covered 45 states, so we're pretty happy about that. We're going to be working on different ways of getting more involvement in the next year or two. As you can see, 76% are multi-state, so they're doing business in more than the state that they operate in. So they cover quite a bit of the country. Two of the first two questions we ask, one I have a slide on, the other I don't, is we just want to make sure we have the right people taking the survey. And you can see here we asked about, Does your family own or manage the operating entity? And you've got 83% said they're either sole or majority owners. The second thing we asked is who is actually taking the survey, and usually it's somebody at the C level. So we're pretty confident we have the right people taking the survey. This has not changed in the last 3 or 4 years that we've been doing the survey in terms of principal industry. You've got manufacturing, construction, and real estate dominate. You can see on the bottom there, agriculture or family farms, which garner a lot of attention in the country due to the illiquid nature of their assets. And you could imagine every opportunity we get, we let the lawmakers know that all these other industries share similar traits in terms of the illiquid nature of their assets. This slide is a great testament to the legacy and long-term thinking of family business. As you can see, 31% are over 50 years old, 81% are 20 years or more. I've seen the 50 to 100 be as high as 40% on some of our surveys. And this is a great slide. Everybody always asks us, why do you spend so much time on income tax policy? Well, here it is. 80% are considered pass-through entities. So S-corps, LLCs, partnerships. So they're paying obviously higher income tax rates than their corporate competition. We have 2 slides that get us into a little bit of a messaging issue. We try to get away from the fact that family business are small business. Family businesses are small, medium, and large businesses. You can see 53% are small, 1 to 50. But if you look at the bottom, you've got 10% that have over 500 employees. So this is part of our messaging. We need to let lawmakers know that small business and family business are not equal. And this is a slide that you'll only see pertinent to family businesses. This one actually is about generational employees in terms of, do you have any? Well, Pat and I have been through many, many travels around the country. We've sat down with many family business owners who's told us that the father worked here, the son worked here, the grandson worked here. So we see quite a bit of this, which is pretty unique to family business. Yeah, there's 2 slides here that show you the connection between family business and community. Actually, our next caucus meeting next week, the theme is community involvement and charitable giving. As you can see here, one of the slides we have is about salary and benefits, and you can see 47% pay above average in terms of pay and benefits. This is the other slide that gets us in that messaging issue that I mentioned. This is on revenues. Again, you've got small businesses, 0 to 5 million, 33%. But again, second year in a row, if you add up on the bottom there, you've got 14% or over $100 million in revenue. So again, it's not family business equaling small business. We asked about, where your optimism was, and obviously it was pretty high. 77% feel they're going to grow this year, which is great news for all of us. And lastly, this is the other slide on community. We asked about charitable giving, and you can see 72% give 60% or more locally. So we've come to understand, family businesses are the ball fields. They are the Boys and Girls Club. So we understand that, without this community giving, there would be trouble if a family business had to sell or, God forbid, wasn't around anymore. So with that, I think I'm going to turn it back over to Pat.
Okay, thanks, John. Appreciate it. So, Jim, do we have any questions so far?
We do not have any questions at this point, but I do want to remind our audience that you can feel free to submit a question through, and we'll be happy to answer that as you go. But we do not have anything at this point in time as well. And I think the slides you show, John, are very important here. I think a lot of folks do not realize how the impact of family business is. When we share this data with our client base, they're absolutely they've actually take a step back and think about it, and they start connecting the dots just in their own backyards and communities, how much family business makes an impact. So thank you for those slides.
Yeah, my pleasure.
Yeah, and I should mention that we'll have time at the end for questions as well. So let's get into the policy overview as it relates to this survey. Income tax continues to be the most important tax policy for family businesses. That's probably because, as John shared with you, 80% of them operate as a pass-through entity. So they're paying ordinary income tax rates of 37%, unless they can take advantage of 199A. Estate tax still is number 2, same as last year. And then you can see capital gains. Wealth tax wasn't even on the radar 2 years ago. It went up from 4% to 5% this year. Wealth tax continues to be a concern of family businesses, even though it's probably less possible or less likely in this Congress. In terms of the estate tax, they would prefer that the exemption amount stay where it is at 14 million per person, double per couple. And next, they would like to see it repealed. I don't think repeal is likely. It's going to cost $300 to $500 billion to repeal the estate tax, and that's probably the main reason that it's not likely. There is also, though, people that understand reducing the rate from 40% to 20% is something that would help a lot of family businesses in America and a lot of voters. And in fact, through Policy and Taxation Group, we have a bipartisan bill that we've helped Congress to introduce that does exactly that. And it reduces the rate again from 40% to 20%. The top economic issue for family businesses is the national debt. They're more concerned this year than they were last year. Family businesses understand what debt does to a business and certainly understand what it does to a country. So it's a very, very important issue, as we all know, and the debt continues to grow. Income tax is number 2 in terms of their economic issues, and then reducing regulations because they feel so overregulated both at a federal and a state level, and then eliminating the estate tax or reducing the estate tax. We ask members of Congress, we ask family business owners, because members of Congress asked us, what would you do if you had more money, meaning you paid less in taxes? Because we actually had a member come into the caucus meeting and ask this question. And in the survey, you can see that 67% of them are going to invest more in their business, and 21% are going to pay their employees more. Only 4% are actually going to pay themselves out more, which is what members of Congress thought was the case. So this is why we do this work. This is why we do this survey. It's so important to get your voice to members of Congress and get them to understand who you are and what you do as a family businesses and what your concerns are. And the last slide in this deck is, as it relates to this survey, is a question we never asked before, and that is, were you subject or are you subject to tariffs? 44% said yes. Now, this survey was done in January, February of this year. So this was before tariffs was really being discussed as it is today. So I suspect that percent is probably going up, but it's all on everyone's mind. We get asked this a lot, and Russell will address that a little bit in the section he talks about. So before we turn over to that section, John's going to talk to us about the caucus, but first I'm going to tell you about our legislative priorities. You can see that what we'd like to have happen is no increase in the income tax rate. And I would remind you that TCJA, all of those tax provisions in the last tax bill are going to expire at the end of this year. Some of the provisions have already expired, like R&D expensing, and bonus depreciation is going to expire in 2026. So these are all critical provisions that are on the table right now that are being discussed by both the House and the Senate. Of course, we'd like to keep the exemption, the estate tax exemption where it is. Capital gains tax, we don't want to increase on that. 199A, which is that provision that allows you to deduct 20% of your income before you actually pay the tax on that income, could go away as well. In addition, keeping like-kind exchanges, avoiding any wealth tax or surtax, and elimination like valuation discounts for family-related businesses, or some of the changes they've tried to do with grantor trusts or elimination of step-up in basis, all still on our radar. We did recently some work with Frank Luntz. If you know who he is, Frank has a great grasp on the voters based on all the work he does with voter surveys. This one we did around family business, and we found that 63% of the family businesses in America support a wealth tax. That's very, very concerning, including 52% of Republicans. So there is this movement in this country to tax the wealthy. We understand where that comes from. It's because people really don't realize how much the top 10% of Americans pay in taxes today. And that percent is 75%. So think about it. 75% of the taxes in this country are paid by the top 10% of Americans, and the bottom 50% of Americans virtually pay no tax. Now, I'm not suggesting that's right or wrong. I'm just saying this movement toward taxing the wealthy really doesn't speak to the issue of how the top 10% already pays. So we are very concerned because of the voters' attitudes. On the opposite side, they do believe that the estate tax or the death tax is inherently wrong. And in fact, this is the highest percent I've ever seen. We've worked on this for 3 decades. 67% of the voters, including 60% of Democrats, believe the estate tax should be repealed. It's incredible. It used to be in the mid or low 50s. So to have it at this percent is pretty amazing. And we're not really sure what got us here. We're looking at that right now. But again, this is somewhat encouraging because the voters do understand that death shouldn't be a taxable event. So with that, I'm going to turn it back over to John, who's going to talk to us about the Congressional Family Business Caucus briefly before we turn it over to Russ.
Great. Thanks, Pat. I'll quickly jump in here and let you know that just on a personal level, this has been probably the most rewarding part of what I've been involved with in terms of policy and family enterprise, is getting these family members to come to Washington and tell their stories. It's absolutely been a great platform. The Congressional Caucus is not ours, it's Congress's caucus. It is a bipartisan caucus like we are, and it is bicameral. We do about 3 different events a year in Washington. Jim knows them well. He's been to, I think, every one. I told him I'm going to penalize him because he's not coming in May. But he has been to them. I'm sure he speaks highly about them. They're very
John, I was going to say is going to these caucus events has been absolutely eye-opening and truly understanding the real of how things are move in DC. And I think we've all learned about it and understood it and have been taught about it in our civics classes and maybe in some college classes, but until you actually see it in action in person and see how the work is done and how. What I'm fascinated with is how much you all get accomplished in a series of 15 to 20-minute meetings. I'm fascinated by that. It's absolutely the work you guys do. I know there's more going on behind the scenes, but I mean, it's fascinating. So thank you, John.
Well, we appreciate your engagement, Jim. Thank you. So Pat, if you could just move to the next slide, please. There we go. So just to give everybody an idea, and I learned this over the last 6 months, is that a caucus has to be reconstituted every Congress. So we are in the midst now of that process. As of the last Congress, we had 45 members. I think it was up to 50, which was just terrific for us. We were really, really pleased about that. We had about a half and half in terms of R's to D's. That was done on purpose. It was done with let's say a slant toward a educational caucus as opposed to a legislative caucus. And it's worked because it brought us to this point where we've got both sides of the aisles involved in the caucus.
So now we're going to turn it over to Russ, who's going to tell us about the big tax changes coming in 2025.
Well, this is a great opportunity. Thank you all for joining us today. I have the privilege of telling you what's going to happen and why, and a little bit about how it might affect you. So let's just run through the developments that we've seen. Some of these you will have read about in your media of choice, but other things we hope will give you a little behind the scenes. You've already figured out that Trump 2.0 is not a retread of his first administration. The Trump folks were ready. They had done their homework over 4 years. They instituted and selected loyalists who would really support the Trump agenda, and they hit the ground running. You can see all the things that at the bottom that Trump did in his very first few weeks. These are items that he's empowered to do under our Constitution without Congress approving them, including the tariffs that we'll talk a little bit more about. But he has gone and undertaken this with vigor. And you may not agree with everything he's doing, but he is certainly doing exactly what he campaigned on. Next slide. We'll see who's on his economic team. These are some of the key players. You've probably seen Scott Bessent. He's very out there in terms of the leader of Trump's economic agenda as Secretary of the Treasury. A lot of the action so far is centered on trying to increase domestic energy production. Doug Burgum chairs that. Kevin Hassett is the National Economic Council. Jameson Greer is very busy over at the U.S. Trade Representative trying to negotiate deals to avoid tariffs or imposing them, depending on the day. And Ken Keyes is about to be confirmed as the Assistant Secretary for Tax Policy. You're also aware, as you see on the next slide, that Congress has both chambers with a slim majority. It's 3 votes in each of the chamber. In the House of Representatives, 220 to 213. If 3 Republicans vote with the Democrats, then they're at a point where they can't lose another vote. In the Senate, if 3 Republicans vote with the Democrats, we have a tie, and the vice president breaks the tie. So in both of the chambers, there's a lot of power is housed in every individual member, because if they are doing something where there's not bipartisan support, then they have to get virtually everyone from the Republican caucus to support it. Next slide. We've got the key players on the tax side, and we have an interesting difference here. On the right, you'll see John Thune and Mike Crapo, the leaders in the Senate. Both of them have been in the Senate for 20 years. John Thune served on the Finance Committee before he became the Republican whip and now leader. And Mike Crapo has been on the Finance Committee for nearly 20 years as well. They know how to move big bills, and they've demonstrated it many times. In the House of Representatives, we have new members at the helm. Mike Johnson's in toward the end of his second year as Speaker of the House, and Jason Smith has had similar tenure at the Ways and Means Committee. This will be the first $1 trillion bill that they have shepherded through the House of Representatives. They are much more in tune with and in communication with the Trump administration and Donald Trump himself, and he will be helping get the bill passed in the House. Next slide. I'm just going to tell you today, there's going to be a big bill passed in the first year, and this year, by the end of this year. You can look at it historically and see that your favorite president or your least favorite president, they all got a bill passed in the first year or close to it of their term, except George H.W. Bush. And he was essentially, by many people's assessment, really a Reagan third term. But it doesn't matter who's in control of the House or the Senate. The president knows he is going to get the credit or the blame for the economy. So he might as well get the laws in a situation where it can grow and be successful. Next slide. So what do we have in terms of proposals on the table? Well, you'll see on the next slide, we have many of the provisions that Pat talked about, the priorities of this organization, from the individual rates and the standard deduction, the child tax credit, the alternative minimum tax for individuals, and you see the estate tax exemption amount. At the end of this year, those amounts, all those provisions expire, and they will go back to their generally lower amounts. The child credit will go from $2,000 to $1,000. State tax exemption from 14 to 7 if Congress does nothing. This will push Congress to actually make a deal to get it done. But there are some business provisions, not as many as the individual provisions, but that Section 199 deduction scheduled to expire. We spent a lot of effort trying to make sure that that's going to be extended and not modified to disfavor family-owned businesses. There are 3 business provisions that have already expired or begun to expire. It looks like all 3 of these will be reinstituted. Research and development expenses will be able to be written off in the year that they are incurred. The tight limit on deductibility of business interest will be loosened just a little bit, and we'll go back to 100% write-off of capital assets through bonus depreciation. Now, In addition to dealing with all of those issues, which if we don't do anything will be a tax increase on all Americans, we now have a series of Trump tax proposals. These are items he developed during the campaign, and I'll just give you a general theme. His most of his proposals focus on reducing taxes for workers to encourage work, and then on the corporate side, most of them are aimed at promoting manufacturing here in the United States and expanding the number of facilities and the kinds of things that we produce here in America. So President Trump supports the TCJA individual provisions that I talked about. And last week he said he wanted to make those permanent. He also says on the work side, he wants to eliminate the income tax on tips, on overtime pay, and Social Security benefits. These three provisions will find their way into the bill. They won't be comprehensive. He won't be able to exclude every dollar of Social Security benefits. He can't allow unlimited overtime pay, but he will, Congress will provide him with a proposal and a new law that will exempt the bulk of those.
Russ,
One big
there's an article in the Journal today that actually covered this for tips and overtime pay, putting caps in there, putting caps on anything over $100,000. There's a nice piece in there today on that.
Yeah, they're going to do that. They will also probably, Jim, limit it to W-2 employees. So you won't be able to, if you're self-employed, you're not going to be able to characterize something as a tip. You're going to have to rely on a third-party employer to do that. I'm not sure exactly how they'll do all that, but I do expect there to be a limit on the amount of tips and overtime pay, as well as an overall limit on your income. I think if you're making $500,000, you're not going to qualify for overtime pay exclusion. So one of the biggest issues this week is really modifying the SALT deduction limitation. Current law in TCJA set it at $10,000 per individual or couple. The Republicans, there's a group of a dozen Republicans, mostly from states that have high state and local income taxes and property taxes. Think New York, New Jersey, California. And they really want that increase. They want the marriage penalty eliminated. So they want to double the amount for a married couple than individuals. And they want the amount raised. They have not reached an agreement on amount. I find it hard to believe they'll find the budget to do more than say, maybe 15,000 per individual, 30,000 per couple. I think it'll be something along those lines. We're likely to know next week what the proposal is by the House Republicans. And then Trump does support the deduction for pass-throughs. On the business side, he has said off and on he wants a lower rate, perhaps 15% for domestic manufacturers. He hasn't defined domestic and he hadn't defined manufacturers. But there are people in Congress and his administration are now plowing through various ideas that range from a rate cut to tax credits for capital costs and investment tax credit for building a new factory on U.S. soil to including more assets like building structures as a depreciable property that can take advantage of bonus depreciation. So they haven't settled on that yet. It may not get resolved until we're in the Senate bill in a month or so from now. And then, of course, he has imposed tariffs broadly and narrowly on particular products, also a 10% across the board tariff that is in place now. And then he has imposed reciprocal tariffs. We'll talk about those in more detail in a moment. So what is the problem? Can Congress just do this and move forward quickly? Well, the answer is no. And if they could move forward quickly, they would have done it by now. But the reason they can't is in part because of the budget. We do have a budget deficit. Pat referenced this in our survey results. It's still hovering around $2 trillion a year. And there's a group of Republicans who say, I'm for tax cuts, but I'm for paying for them with spending cuts or some other way so that we don't make the deficit and the debt worse. The debt, as I might mention, we're on the edge of having to have an increase in the debt limit. And so we're waiting on Treasury to give a specific date by which it needs to be increased. It's likely to be increased as part of this tax bill or separately within the next couple of months. With respect to TCJA, here's the challenge. Extending all the provisions will cost $4 trillion over 10 years. So it's about, on average, $400 billion a year. If you add up the differential between a 39.6% rate and a 37% rate, the $2,000 child credit instead of $1,000. So Republicans are facing the question, what do they do? This figure also doesn't include the Trump tax ideas or other member ideas that are a priority. So what are their options? Well, they can just say we're not going to pay for it. That's what Mike Crapo at the Finance Committee engineered in the budget resolution, which sets the rules for the road. And he said, look, we don't pay for every spending every year when we do our budget. We assume the government's going to spend as much as it did last year. Why can't we assume that they're going to collect as much tax as they did last year under the current policy? They also can do a lot of cutting of federal programs, and I expect that they will, between $1 and $2 trillion. They'll start with some of the Democratic provisions from the Inflation Reduction Act. They're looking at Medicaid cuts. They're looking at some revenue increases that on universities, particularly Ivy League schools. They're looking at eliminating some of the energy tax credits, like the electric vehicles credit. So they'll come up with $1 trillion or $2 there as well. If you counted tariffs, there would be a lot. There could be $3 trillion or so in new tariffs coming in over the coming years. If, in fact, people continue to ship their items and Americans continue to buy them. We haven't seen a situation like this. So we're not sure how it'll play out in the economy. So those are some of their options that they have. To get to the tariff issue, which if you produce or bring in tangible goods you're already dealing with, Trump started in his first term by imposing some tariffs on China, and he's imposed 25% tariffs on automobiles brought into the U.S. back in March. They're negotiating those right now. He also then imposed reciprocal tariffs on most American trading partners, minimum of 10% and up to 50% in some cases. And so right now you'll read about this week some negotiations that are about to launch between China and the U.S. Those are the highest tariffs that Trump has imposed on any country is China, over 100%, and China has retaliated by imposing tariffs of over 100% on U.S. goods. So some are aimed at changing behavior. Others appear to be designed to encourage American investors to expand the supply chain in the U.S. What are some other tax increases that might be on the table? We're not going to have a corporate rate increase. There's been some discussion about business SALT limitation that would match the individual limitation on state and local taxes. The Senate seems very opposed to this, but the House is somewhat open. The latest intelligence we have, and we did have Jason Smith from the chair of the Ways and Means Committee at our office this week, was that if they do a business SALT limitation, it'll be limited to income taxes and won't include or affect property taxes. You'll be able to fully deduct those. There are several other changes. I will point out the one that has had a lot of discussion lately, which is a tax on high income individuals. So there are Republicans who have said, maybe we shouldn't keep the 37% rate. Maybe we should let it float up to 39.6. Maybe we should impose a new bracket for millionaires at 40%. They've said this publicly, and they've been discussing it behind closed doors among Republicans. The leadership, Pat has us working the phones and the Zoom and the doors every week, all week. And so we were able to get the leadership of both the House and Senate to say, no, we're not going to allow an increase in the top rate. But I can assure you the discussion will continue, and there may be other ways that creep their way into this bill that would effectively discourage companies from paying more than $1 million to their employees. We might make that non-deductible to the employer. They also could look at deferred comp arrangements. Some will raise those issues as ways that they can go after pay for the wealthy, as it might be described. All right.
And Russ, I think
yeah.
it's important to point out about that $1 million tax on $1 million or more is people think that that's the very wealthy, but if a pass-through entity, of which we know 80% of family businesses are pass-through entities, want to make sure everybody just connects the dots here. That means if a business makes more than $1 million in income, they're going to be in that category as a pass-through entity. So it wouldn't affect just wealthy. It would affect every family business that makes more than $1 million a year, which is not a huge family business.
Right. And the 199A, the deduction pack can only really reduce your rate down to 30%, which is still higher than the 21% corporate rate. In fact, Jim, I see a question here about this issue. Why do so many companies operate as pass-throughs when it looks like a C Corp would be more tax efficient as well as improve cash flow? Well, that's a question I've asked of many of our clients. We did, after the rate was reduced to 21%, we had a number of clients who did switch from pass-through status to C Corp status. But for many businesses, there are still a lot of advantages of the pass-through structure. For some, it's just been that that's the way they've been organized for a long time. For others, they don't want to be subject to rules about C Corps. They don't want to perhaps have additional regulation that comes at the federal or different state level. Jim, you may know some other rationales as well.
From my experience, that's the business they start. That's how they start. They're starting their business from the ground up, so they're using a flow-through entity. They're using the LLC. Some of them are sole proprietors that switch to an LLC, and then they never do the analysis work to go back and say this business has grown over the last 20 years and we're very, very successful. They never go back and do the analysis and say, does it make sense to convert to a C Corp? Yeah. So it's like it's just tried and true. And
I've seen a lot of them that have done that analysis,
Yeah.
and I think that what they determine is there's more flexibility in being an S Corp or an LLC or an LP than there is in a C Corp. And you're not subject to things like, accumulated earnings tax and things as Russ mentioned. I think there's more regulation, there's more scrutiny around being a C Corp. And I think that's because I know a lot of them that have looked at it and still haven't switched back. I mean, there are, as Russ said, some have or switched to a C Corp. But I think that's one of the main reasons is just it gives them that flexibility and less regulation.
All right. Keep those questions coming. So what's going to happen next? Well, we're right at the very beginning. Next week, actually, we already started last week in the House of Representatives with each committee sort of writing up a bill that can be included in a broader, we call it reconciliation bill, but it's a big budget bill that can address virtually anything under Congress's jurisdiction. They will try to pass that in the House of Representatives by Memorial Day. The Senate's likely to take it up in June, try to finish it by the end of July. I expect they will get a bill to the president's desk before they take their annual August recess. This is a special once a year sort of vehicle that Congress is allowed to do if they pass a budget. They have passed a budget, so they get the privilege of doing that, where the bill cannot be filibustered in the Senate by any single senator. There's a definite end to the debate, and they can get it going. So what is this bill going to look like? I'm not giving you a government document here. This is Russ Sullivan's assessment of how this is going to look at the end of the day, and I update this weekly, so it'll change by next week. But on the tax cut side, we're likely to see an extension of all the TCJ provisions for either 9 years or they'll be made permanent. If they get certain rulings and make their numbers work, they may be able to make it permanent. Otherwise, they'll extend current law in general for at least 9 years. The business extenders, these are the items I talked about, including bonus depreciation. They cost a significant amount. Trump's proposals are the wild card. We don't know exactly how much they're going to cost. If you went whole hog, you could spend, $3 trillion to implement them. They're unlikely to do that, but it's definitely going to cost them, close to $1 trillion, I would expect. The child credit's going to get expanded probably to $2,500 per child. The SALT cap is going to go up, as we talked about before. So those are two changes to TCJA in addition to just extending. And then the Senate has not really showed its hand on some of the things they want to do. But Chairman Crapo told me that they are definitely going to add some provisions. He mentioned three. He mentioned the expansion of the low-income housing tax credit. He mentioned an expansion or a redo, opening up GO zones for economic development and a capital gains advantage there. He also said there are some Republicans in the Senate who want to do more on the estate tax than just extend the exemption amount. So we are working to try to get them to move toward that lower rate, toward 20%. That will be a tough climb, as Pat said, to get them to do that. But we at least have a shot, we believe, in the Senate. So how are they going to pay for all that? Some of it they're going to pay for in this bill, and that's the spending cuts I mentioned. It's repealing some of the energy tax credits. There'll be some new international taxes. They've chosen not to disclose those, but the president has made some recommendations behind the scenes. There'll be a few domestic tax increases. C corporations, public corporations who do stock buybacks are going to probably have an increased tax on that. The business SALT provision could raise several $100 billion if they include that. But this last category is really items that won't be in the bill, but are actually happening in our economy. And we're talking about many of the DOGE cuts, the downsizing of the federal government, both from a payroll perspective and the program perspective. The tariffs, as I said, 10% tariff globally could raise $300 billion a year or $3 trillion over 10 years. And if Republicans make the right choices in this bill and spur more investment and expansion, job opportunities, then we'll have more revenue from just general growth in the economy. All right, finally, looking at the particular individual items. I've already covered the individual rates and the battle over millionaires. Capital gains are expected to be exactly the same. SALT cap, we've covered the increase that is likely. The AMT, they thought about actually not extending this, but I think they've decided to in the House. And the estate tax exemption we've discussed as well. On the business side, pass-through deduction today is looking pretty good. They would extend it as it is. There have been some efforts to expand the kind of businesses that can qualify that are in the service sector. I don't think those are likely to happen. Members of Congress view accountants and lawyers and financial planners just differently and don't believe that they really need the deduction. The pass-through limitation, loss limitation at $250,000 and $500,000, that's likely to be extended for the entire 10-year period, and we've covered the business provisions. All right, there's your update. Happy to entertain questions or discuss items in more detail.
So for the last 3 slides, I just want to kind of bring it home to everybody in terms of real cost to you. So on the estate tax exemption, as an example, if the estate tax exemption dropped to $7 million from its $14 million per person, and there's been conversations about that, not recently, but there was earlier in the year. That means that as a result, over 10 years, you would not be able to gift $11.5 million. If the top rate reverted back to 39.6% from where it is today at 37%, which it would do if TCJA was not extended, and you had a business that was making $10 million a year, that means you would be paying $2.5 million in taxes for the next 10 years. And lastly, if 199A did not get extended, again, that's where you get to deduct 20% of your qualifying business income. You would be paying $740,000 a year in taxes every year So over 10 years, you would be paying another $7.4 million. So there are real consequences, economic consequences to TCJA not being extended. Certainly making it permanent would be wonderful. We're not sure that that's possible based on what Russ is telling you about the cost to do that, but we would love to see that happen. So with that,
There's a question here,
um,
Pat. There's a question here,
okay.
Pat, from Don, actually from Don Luskin. It says, "Why always talk about extending expiring provisions? Why not just make them permanent?"
Well, I'm going to answer that quickly, and then I'm going to turn it to Russ. The reason is it costs too much. Go ahead, Russ.
I think that's right. Certainly, I think all policymakers would agree that certainty that comes with making it permanent would certainly unleash more risk taking, more investment, and be good for the economy. But they're also concerned about the bond market and the stock market. And, when the tariffs were being imposed immediately, there were some economic concerns. And in fact, President Trump paused because of those concerns about tariffs. The same is true on the deficit. And if you, lower the rates so much that people get concerned on Wall Street, you could actually, and not just Wall Street, but investors everywhere through their 401k plans and everything, that you could, cause some economic problems. And let me give you a specific example. So Trump, when he's asked for his provisions on the no tax on tips and overtime and Social Security benefits, he's really only asking them for like 4 or 5 years. He would like for it to be permanent, but he understands and says, I'm not sure whether that would cause us more problems from a budgetary perspective and interest rates and inflation and that kind of thing. So I'll just ask for it for 4 to 5 years. The same on like the bonus depreciation. We expect that to be extended for 5 years, but not permanently. And that's just part of the dealing. I think if the tariff revenues start coming in and the spending cuts are realized, I think before the bill's through, they might actually make some of those provisions permanent. But I think they're waiting to see whether overall we're going to at least minimize the fiscal changes or at least begin to reduce the deficit on an annual basis.
So, do we have any other questions from anybody and our listening in? I think we've had a few come in, and I think the questions that we submitted prior have been answered through this presentation. But
Yeah,
also,
Jim, yeah, but the only one I will ask about is that I think everybody's probably interested in, well, Russ touched on it a little bit, and that is about timing. Russ, I mean, you've been doing this a long time. What do you think the timing of this legislation really is? When your slide says, late summer, what do you think is realistic?
I think it's realistic that it all gets done before Labor Day. And here's why. 2 reasons. One is the budget resolution itself. The authorization to do the bill under special terms expires September 30th. So they don't want to risk getting close to that date and have to start with a new budget resolution and go through the process again. Second, if you're the president or a Republican running for reelection, you want your agenda, your economic agenda, to be put into place now, not 3 months before you're up for reelection in November of 2026. They want to make the new tax cuts, be that bonus depreciation or on the business side or no tax on overtime, effective January 1 of this year. They want people to start seeing the benefit of that in their paychecks or in their investments, returns, their capital stack they're putting together for various business deals. And they want to happen soon so that it filters through the economy before they face the voters again. So that's another reason they want to do it as quickly as they can. But the reality is the difficult choices that they face on the spending cuts and even on some of the tax provisions means that it's going to take a couple more months. So I would say They normally schedule to go out the whole month of August. I think if they're not through by July 31st, President Trump will say, guys and girls, stay here. We're just going to stay till we get it done, and then you can go home to your district for recess. And that's what they'll do. They'll cut a deal and sort of get it done in August.
You see anything, Russ, that could derail all this before September?
Sure. So let me just be honest. I've lived through some of these items on both sides of it. There are Republicans who've won in districts where Joe Biden or Kamala Harris won the election, but they, as a member of Congress, as a Republican, won the district because they were more in tune with the voters, and they ran a good campaign. They fear the following: incessant ads by Democrats or opponents that say Congressman X voted to cut Medicaid for poor children with disabilities, and instead they gave tax cuts to the wealthy, the millionaires. And they do not want to be in a situation where they have to defend their vote on those terms. They've got to either have the bill where they can't be criticized for that, or they've got to have a strategy in place to show that it's not true. That all takes time and money. But, I was there and pushed Democrats to vote for the Affordable Care Act. They did so. And then 2 years later, many of them in the House and Senate lost their seats because they had voted for government-run health care. Okay. I did the same thing on the opposite side in 2001 with Pat. That's where I met Pat working on that bill, where we actually did eliminate the estate tax for a brief period of time. In that case, Democrats joined Republicans in voting for it because we had a near surplus, and they were afraid if they voted against the tax cuts, they would lose their race the next time. So there's politics infused in all of this. And, if the folks from New York who ran saying, I'm going to eliminate the SALT cap, if they only get 30,000, can they go back to their voters and say, that's good enough, you should reelect me? We don't know the answer, but those members are going to decide whether that's enough. And that probably would be the kind of thing if we have 5 Republicans who say, I'm not voting for Medicaid cuts, or the SALT cap has to be at least 50,000, they won't have enough votes in the House to pass the bill.
Well, what happens then if we don't have this, if we don't have enough House to pass and we go into the fall?
Fascinating question. And of course, the Policy and Taxation Group, led by Pat Soldano, is so sophisticated, we're preparing for that plan B. So if in fact they can't get enough votes among the Republicans, we've already begun talking to some Democrats who, toward the end of the year, if we get to December and the bill hasn't passed yet, I can assure you there'll be pressure from constituents for Democrats to vote for the bill, even though some Republicans may not be willing to do so. And we are working with some Democrats to try to have them ready to provide the necessary number of votes to have the bill passed. Won't happen by August, but could happen in December.
It's outstanding. It's outstanding. So it looks like we don't have any more questions, and we're getting ready to bump up against the hour here. So I really do appreciate you all sharing this. And for the folks that are on the call today, on this webinar today, I would really encourage you to start, if you aren't currently following the work, Policy and Taxation and Family Project USA, Enterprise USA, that you actually start paying attention and following and really seeing what they're doing, because these are the folks that are here advocating for not only our clients, but for you financial advisors and other RIAs on the call today, advocating on behalf of your clients. So I would really encourage you to take a hard look and follow and engage. My experience in going up to DC and participating in all this, when you walk into these offices and you are from these folks' districts, they listen and they engage. And some of the folks that have walked into the room They've literally and some folks, they've rolled out the red carpet for them as they in listening to their concerns. So I want to close on that. If you haven't, or if you're not, please pay attention and engage with Family Enterprise USA and Policy and Taxation Group. So Pat, Russ, and John, I really appreciate your time this afternoon, and thank you for the update, and thank you for the work that you do. And if you have any closing
Well,
remarks,
Jim,
please do.
thank you for this opportunity, and thank you for your tremendous support personally, as well as the company, and thank you for those very kind words. If there is a family business listening to this and you're interested in coming to DC, as John said, the caucus meeting is May 14th. We'd love to have you in the room. We'd love to have you do Hill visits with members of Congress. They really need to hear your story. Please let us be your voice.
Yes. So with that, thank you very much. Thank you for everybody for taking the time today. Enjoy the rest of the afternoon, the rest of your week. Thanks, guys. Thank you very much.
Thank you, Jim.
Take care,
Thank
Jim.
you.
Bye-bye.
Bye-bye.